Hey guys, Koukun here. Today I want to give you an update of my index fund investing. I started investing into index funds in April of this year, just shortly after the market crashed due to COVID. I didn't start with a lot of money. My first deposit was $100. The next couple of deposits were only a couple $100 each. But I made it my goal this year that I wanted to add a significant portion of my income each time I get paid into index funds. So I've been able to consistently add to my position up to this point. So in total this year, I've been able to contribute a total of $13,740. So that's been taking a piece off of my paycheck every time I get paid. So when I started investing in index funds, I made the decision to have two index funds that I was going to be investing in. The first one was an S&P 500 index, so it's called VFV, which is the Vanguard S&P 500 index, so it tracks the 500 largest companies in America. This fund comprised of 75% of my portfolio, and the other fund was VCN. So this is about 200 of the largest Canadian companies. The Canadian portion I put 25%, the American I put 75%. At the end of the year, the total profit I've been able to make on this investment portfolio has been $940. And in total now my index fund portfolio is worth $14,680. And my rate of return, so my profit, so to speak, from doing this investing has been just shy of 7%, which is pretty good considering that the larger portions of my deposits were actually later in the year, so they haven't actually been invested for more than a couple of months. When it comes to index fund investing, I'm not expecting 7% a year. I'm not expecting any kind of consistent return. The way I look at it is that over the long term, over the next 10 to 15 years, I will generate consistent returns anywhere from the 5 to maybe the 8% range on average over a long period of time. However, in the short term, in a given year, it can be up 10%, it can be down 10%, maybe more, maybe less. And that's okay. That's part of being a long-term index fund investor. You can't guarantee the return in any short-term time period. At the end of this year, I've made a couple of decisions to make some changes in this portfolio. The first of which is that I've decided to actually sell both of those index funds and instead go for what's called the Vanguard Growth Asset Allocation Index Fund. So this is called VGRO, VGRO, and it's a fund of funds. What this means is that you get to invest in the one index fund, VGRO is the name of it, and it tracks 7 other index funds. So it has, I think, 33% in the American stock market, I think about 24% in the Canadian stock market. There's a portion for the international developed nations, a portion for emerging markets, which are sort of the countries coming up, and it also has some bonds in there. So VGRO specifically is 80% in stocks and 20% in bonds. One of the things to consider is that VGRO actually has a slightly higher expense ratio. So if you know, the biggest benefit of investing in index funds is that they come with very low fees. Most mutual funds offered by your bank or most financial advisors come with anywhere from 2 to 3% in what's called the management expense ratio. So that's fees paid every single year of the total amount you have invested, not of the profit, 2 to 3% of the total amount. And it can sometimes eat up anywhere from 20 to up to 50% of the profit you will make from your investments. With index funds, it's very low. So the first 2 index funds that I was invested in, where it tracked the stock markets directly, those came with fees under 0.1%. This new investment VGRO comes with a fee of 0.25%. So it's a little bit higher than if you were to own the index funds directly. However, when it comes to index fund investing, you don't want to make a lot of changes to your investment style. So even for me, I had to really think about, was this something that was necessary or was I trying to be too involved? So I had to really think about it for a while before making this decision. One of the reasons I decided to invest into VGRO is that it has an 80% allocation to stocks and 20% to bonds. Now, if you watch some of my previous videos, I'm really not a fan of bonds. My perspective is that they pay a very low interest rate because interest rates are very low. They've had a good performance over the last 10, 20, 30 years, but the last 10, 20, 30 years have also been a time when interest rates have been coming down. So therefore, bonds do well when interest rates come down. The future is unknown, but right now, given the current interest rates, the likelihood of them really providing significant performance is really not there. The reason I decided to go for an 80-20 split in this new index fund versus something like VEQT, which has a 100% stock allocation, is that I'm looking at it more from a personal perspective than I am really an investment perspective. So here's my thought process. I just experienced the market crash in COVID. However, I had none of my money invested in the stock market when that crash happened. I only started investing after the market had crashed, and I was almost investing on the way up. I don't know yet how I will react to a market crash. I'm almost trying to protect myself from how I will react to the next market crash, whether it's 5, 10, 15 years later, maybe sooner, maybe longer. But on average, I think the statistics are every 10 years or so, there's a market collapse. This market crash came 12 years after the last one. So every so often there is a market crash. I don't know yet how I will feel having a significant amount of my savings invested in the stock market and then watch it go down 20, 30, 40% within a couple of months. The reason I decided to add some bonds, not a lot, it's still only 20%, is so that when the stock market goes down, the bond market generally preserves its value a little bit better than the stock market. It may also go down slightly, but it will generally go down much less than the stock market. Therefore, as a whole, my portfolio won't go down as much. So going back to the thought process, I want to set up my investments such that I stay with them for the long term, meaning I stay with them even through any market crashes that may come in the future. So the idea behind adding some bonds is that it will definitely reduce my potential long-term profits. However, it may help to have me stay in the game over the long term, especially during very volatile times. One of the other reasons I really like this new fund VGRO is that it has the allocations already set up within the fund for Canadian stocks, US stocks, international stocks, emerging market stocks, as well as bonds from Canada, the States, and international markets. So it's already set up across, I believe, 7 different index funds, and they have their own allocation percentages. The beauty of this setup is that I just buy the one investment, right? So I go on my Wealthsimple Trade account, I search VGRO, it's $29 per share right now, so I just buy in $29 increments. However, within the fund, when, for example, the US market does really well, and then the Canadian market and say the international markets don't do as well, what ends up happening is that as one part of the index fund outperforms, they sell off a piece of the investment that's doing really well, and then they put it back into the other investments that are not doing as well. Therefore, this is what's called rebalancing. So it always stays within reason within those asset allocations. I believe they have a 2% margin. So I believe if the US stock market is allocated to be 33% of the portfolio, it can go up to 35, it can go down to 31, but it has to stay within that range. Now, this is amazing. Let me share from my personal experience. Just in this past year, my Canadian investments of the 25% did around 8%, and my US investments did around 6%. And I noticed in myself from seeing one investment perform better than the other, I had a desire to sell some of my US investments and put more to the Canadian investments. This is sort of my natural reaction, seeing that, oh, one is doing better than the other. Let me put more money into that investment that's doing better in the hopes of making more return. However, fundamentally, this is a flawed thought process. When an investment has done really well, the chance of it continuing to do really well is less likely than the investment that has not done as well having a chance to do better over the future. This is only applicable to a diversified investment that's spread across, multiple different stocks and different industries. So you can't just look at a single stock and if it's not doing well, assume that it's going to do well in the future. This is more with index funds. if the Canadian, for example, the last 10 years has really underperformed the US market, the US market has done like one of the best returns over the last 10-year period, you may be tempted to take your money out of the Canadian stock market and put it into the US stock market because it's been doing well over the last 10 years. However, the likelihood of the US stock market doing as well as it's done over the next 10 years is much lower than the Canadian stock market doing better over the next 10 years than it has over the last 10 years. The reason, again, why I like this all-in-one asset allocation ETF is I don't have to think about this. Because I know this, I know I'm going to be tempted to, play around with my position, sell some, buy others. And while it may seem fun, I really want to make my index fund investing as painless and as simple as possible. So with this new investment, I know that it's already set to these allocations. It's 1/3 American. So if America does well, I'll get 1/3 of that benefit. I have 24% in Canadian stocks. I have 24% in Canadian stocks. So if Canadian stock market does well, I'll get a piece of that. It has some exposure to global equities. So if some other countries have stock markets that perform really well, I'll get a piece of that. Now, I will never do as well as any one of those countries or areas. If one of them does really well, my index fund won't do as well as that one, but I'm guaranteed to get the benefit from all of these different sectors. So if it's the American market, the Canadian market, the global market, emerging markets, whichever does well over the next 10 years, I'm going to get a piece of that action. And to me, this helps me reduce how much time I'm going to spend thinking about, am I invested in the right allocations, in the right index funds? It just takes that thought process out. I'm invested now in everything, and as a whole, I will do as well as everything does. Going back to the asset allocation, so the 80% stock and 20% bonds. The reason this is a huge benefit, especially with this benefit of rebalancing that VGrow has automatically, is that as stocks come down, bonds preserve their value, but then within this fund, the managers of this fund automatically, like clockwork, will start selling off the bonds as stocks come really down in the next market crash, and they'll sell off the bonds, reinvest that back into stocks at lower prices. If the stocks go even lower, sell off some of the bonds, buy into stocks. So it allows you to rebalance the portfolio, essentially meaning you're buying in the low. And of course, if stocks do really well, they'll be selling off the stocks at the high as well and buying bonds. But as a whole, it smoothens out the ride to a certain degree so that you get the consistent performance without as much volatility. It does reduce that to a certain degree. So what's next for my index fund investing? Right now, all of my index funds are in my tax-free savings account. My plan is to move them into my RRSP, and based on my current tax bracket, I'll get a refund somewhere in the range of around 40%. So what I'm going to do is transfer the investments to my RRSP, get that tax refund, but instead of just taking that tax refund and spending it, my plan is to take that and put it back into my tax-free savings account. So I'm essentially just building my tax-free savings account up again, and I'm going to invest that into the same investment, into VGrow. Along the year next year, I'm going to consistently add more funds into both my RRSP as well as my tax-free savings account, hoping to max out both accounts over the next couple of years. I'm a huge fan of index fund investing. If you watched any of my other videos, you know that I'm a heavy real estate investor as well. And in a way, this is one of my efforts to actually reduce my exposure to real estate as an asset class, because it comes with some intrinsic risk when I have all my eggs in this one basket. Now, I do feel that real estate is a investment that can produce superior returns, and I understand it better. I have localized knowledge of the markets I'm investing in. So it comes with a lot of benefits where you can almost have an information advantage. However, in the back of my mind, I want to set myself up where my finances are not affected by any one external force that can really affect me. So if the real estate market crashes, I don't want my personal finances to crash. So I want to be invested in real estate. I want to have a business that's, performing well, creating revenues, and I want to take some of those profits and put it into index funds where it's globally diversified and it's almost a store of value separate from my real estate investing. And then as a whole, build up both of these so that they create that financial independence and it creates stability where I'm not totally relying on any single investment. I'm not totally relying on my business. All of these are working together to create a strong financial future. I will definitely be going into more videos about VGrow. This is an investment that I think people really should know more about. It's a free lunch, so to speak. It's literally the lowest cost way to invest into something so simple yet so diversified, and I wish more people knew about it. Unfortunately, the way that Vanguard is structured and the way that index funds are structured is that there's no one incentivized to teach people about this kind of investment, simply because it's not a investment that can pay an advisor, that can pay a salesperson to sell it per se, right? The fees are so low, and that's one of the beauties of it, right? You get a better return because you pay less in fees. However, it's really left to those who do the research themselves, because very few people actually promote it since there's no incentive to promote it. So I hope that I can use this platform, use this YouTube channel to share more about it, because I'm using it for myself. I've just convinced my parents to invest their retirement savings into it as well. And yeah, it's something that I wish more people knew about, especially for the investments that you're going to put in mutual funds anyways. I was just looking at one of the largest Canadian mutual funds. I think it's RBC's Select Balanced Portfolio. It has something of like $46 billion in investments, and they're currently charging a 2% management fee. If those investors just put it into the balanced Vanguard asset allocation ETF, they'd be paying the same fee as mine, which is 0.25%. So as a result, RBC is making $860 million a year from that fund, just in the fees that they collect, versus if those same investors put their money into Vanguard's asset allocation ETF, they'd be saving like $700 odd million in fees that the fund is paying every year. It's definitely something I feel, for those who know about index funds, it's obvious, it's the way to go. There's no question about it. But there's definitely a lot of people who do not know about it or do not know enough about it to feel comfortable to put their funds into it. So I hope that these videos can give you some kind of confidence, because this is literally what I'm putting my own money into. I believe in this product as something that has good future expected returns based on the fact that it's diversified, it has low fees, and it's a very accessible investment. You can start with $29, so you don't need a lot of money to get started. It's not going to make you rich. It's not going to create insane rates of return. You're not going to be a millionaire by doing this just by contributing a little bit every month. You do need to save a significant portion in order for it to become something worthwhile. However, it's a far better alternative to so many other kinds of investments. It's liquid, diversified. There's so many benefits to it that, again, I'll maybe make a more detailed video in the future about it. But this is what I'm putting my own money into, and I hope this video can be helpful. And again, the thought process is long-term investing. Keep your life simple. It's one fund. It's well diversified. There's not much to think about. I'll put a link in the description to Vanguard's website where it describes what are the actual investments in it, the fun facts and the performance and all of the details. But the important thing that I would highly recommend you to consider when looking at these kind of investments, do not focus on the past performance. There are many mutual funds that will tell you that, hey, we are actively managed. So we have a manager who's picking and choosing stocks. And over the past 10, 20, 30 years, we have outperformed the index. This is a very biased view of looking at investment funds, because on average, most mutual funds underperform the index. However, there are exceptions to this. There's usually 2 to 5% of mutual funds that outperform the index. right? So those few funds end up collecting a whole lot of assets, right? People see, oh, that fund's doing well, let me put my money over there. And then, like I mentioned about the idea that when a fund does well, when an investment does well in the past, its future is likely going to be less profitable. It's likely going to make less of a profit in the future. This is the same for individual stocks. If a stock has performed very well, the likelihood of it in the future to perform well is very low. So the same applies to mutual funds, especially actively managed mutual funds once they accumulate a large amount of assets. If you have a manager, with a small fund that's, good at what he's doing, maybe he chooses good companies. But as the funds increase to a massive size, especially like this RBC fund, $46 billion, it's hard for a manager to continue to outperform. However, these are the funds that exist because a majority of mutual funds get closed down over time. So what happens is that a bank will create 10 mutual funds, for example, to outperform. So then they become popular, people move their money there. The other 8 that maybe don't do well shrink in size to the point that the bank just closes them down and cancels them, right? Or takes those investors' funds and transfer them to some other fund that's doing well to that point. But then what happens is that moving forward into the future, these funds don't do well. So anyways, it's a bit of a ramble, but don't be fooled by past performance. If an investment has done really well over the past, it doesn't mean it's going to do really well over the future. So keep that in mind. It's never a guaranteed with any investment. And in a funny way, this applies even to real estate, because many people look at real estate as, it's been this great investment for the last 25 years. Again, the same thing applies. What was a great investment for the past 25 years doesn't necessarily mean the next 25 years are going to be the same. So be aware of that. I've been telling my clients more and more these days, listen, the last year has been great for real estate. Don't expect the next year to be. Don't expect the next 5 years to be, 10 years to be the same. I still think that real estate is a great investment simply because of other reasons that come with the way you invest in real estate, the fact you can put 20% down and get a mortgage for the rest, and your returns are amplified. But it doesn't mean it doesn't come with its own risk. So just be fully aware of it when you get into any kind of investment, that the past performance does not indicate that the future is going to be the same. I think this was a bit of a longer video, but I hope you enjoyed this this update. If you like these kind of videos, please let me know in the comments below. I want to share more about my index fund investing journey. And I've even had this little idea. I'm not 100% sure about it yet, but I want to share these updates from now until it hits, I don't know, call it $1 million, right? I want to share the progress and the journey along the way, and share what I learned through this process, because I'm definitely not an expert. I'm not a financial advisor. I don't have any sort of accreditations in any kind of, well, basically any kind of financial designations. I basically just research on my own and find useful information that I think can be helpful to my finances, to my parents' finances. I'm helping them with setting up their retirement accounts. So I'm just researching on my own, and I want to be able to share that. But definitely seek professional advice. Do your due diligence. Make sure that the decisions you make for your investing are right for you, because everything I've said in this video is my opinion only, and don't sue me. Thanks. All right, have a good one, guys.